Hey everyone, welcome back to the channel, which is all about how to generate high passive income from a diversified portfolio of high yield funds. So today's video, we're going to talk about the number one voted topic to cover next in the recent survey I did. So thanks a lot for everyone who voted. This is pretty much the number one concern, the number one criticism, the number one question I get typically from newer income investors or newer investors in general. So it's really important. I figure I actually do a video to cover this and really nip it in the bud, because I know I cover it a lot indirectly in a lot of the videos that I do, but I'm going to make a video just on this. So hopefully it'll put your concerns to rest if you fall into this category. So the number one concern I get is these high yield funds that I typically cover and talk about and invest in, talk about on my channel. If you look at the stock chart, it looks like there's a downward trend over time. It looks like their NAV, or their net asset value, is eroding, right? That's the number one complaint and question I get. The NAV is eroding. Why is it happening? Are they bad investments, et cetera, et cetera? So of course, if you're going to look at the stock chart, they're going to seem like bad investments, but the stock chart is only one side to the story for any stock or fund that actually gives out income. So in today's video, I'm going to hopefully go through all the points and hopefully put your mind at rest and really explain how these high yield funds work, and that you cannot look at the stock chart to understand or see how these funds are actually performing. So let's get to it right away. Let's go through a few points here, and then I'll try to show you some live example with some of the funds, some high yield funds. So hopefully you could piece the information together and you'll understand exactly what I'm talking about. Let's get to it right away. So the first and most important point that I'm going to make is that when you're analyzing or looking at any high yield fund and trying to decide if you're going to invest in it or not, you can't just look at the stock price. You have to look at the income. You have to include the income, which you don't see at all in the stock chart, right? So important point number one, you have to remember to include the income in your analysis. So basically, everyone, when you're trying to determine the performance of a fund or how it's performing, if it gives income, whether it's a dividend stock, high yield fund, whatever it is, you have to look at, much more importantly than the stock chart, the total return. Okay, so total return is actually the key for any fund that gives income, not the stock price or not the stock chart. It's the total return. What's total return? Well, it basically includes the income. Okay, so if after 1 year the total return is 10%, it means the stock price and including the income, you make a 10% gain. So if the stock gives no income and it's $10, to make a 10% gain, it has to become $11, right? That's 10%. You made a 10% gain. So if a stock that does not give any income, like a growth stock or anything, goes from 10 to 11 within a year, you make a 10% gain, a 10% return in that 1 year, but only if you sell the fund, right? Because the next day the fund could go down and then it's different, right? So that's an example of a total return. If it's a fund that gives out income, so let's say a fund gives out income is $10 and it gives you $1 in dividends that year, but the stock price stays flat at $10. It seems like within a year, $10 investment, $10 stock price stays at $10. It seems like you got zero, but it's not true. You actually got 10% because you got that dollar in income, whether you get it monthly, whether you get it quarterly. If you get $1 of income per share on a $10 stock, and within a year, and the stock stayed at $10, it's actually the same thing. It's as if it went to $11. Basically, right? You got that dollar in income, whereas the other stock, you didn't get anything in income, you got it in share price appreciation. So that's why it's important to look at the annual, it's called the annual compound total return. So if a fund's been out for 5, 10, 15 years, if you look at that number, it'll tell you on average every year what is your total return. Is it 5%? Is it 8%? Is it 10%? That will include both the stock price and the income or the dividend. So the total return is definitely your best indicator, and it's the income with the stock price. And by the way, total return, it includes fees, right? So the total return is after fees are paid and all that, okay? So looking at the stock price, everyone, makes absolutely, or looking just at the stock price, makes no sense for anything that gives out income. If you're looking at something that has no dividend, no income whatsoever, like Amazon stock or a Google stock or a Tesla stock, then you could look at just the stock price because there's no income. So everything has to do with the stock price. Okay, so that's very important point number 2. Look at the total return on average every year, compounded. You could see that for every fund, typically on their website. Not the stock price. Another point to remember is people say the NAV is eroding. It looks like it's eroding. The NAV is not eroding because it's being given out to shareholders. How could the NAV be eroding if it's literally being given out to you in the form of income, either monthly or quarterly, right? So that dividend, whether it's 10 cents a month, whatever it is, that comes from the NAV. Right? It doesn't magically appear. The NAV gets reduced by 10 cents. It's been given out to the shareholders, which is us. So distributions are part of the NAV. It's just being given out. So think of it this way, right? If a stock price is $10 and it has a 10-cent a month dividend, which is $1.20 a year, like most split funds like EIT, $1.20 is a very common dividend amount for a lot of the funds that I own. After a year, the stock price drops to 9, right? 10 to 9. So it seems like the NAV eroded from 10 to 9, right? But you're wrong. You need to count the income. That's what I mean by you need to count the income. So you need to include that $1.20. So in reality, the stock went from 10 to 9 plus $1.20. So it's actually $10.20, not $9, right? But the stock chart doesn't include the income. Stock charts, it's just stock price, right? It gave you that $1.20 throughout the year, 10 cents a month. It could be dividends, it could be capital gains, it could be covered call income, whatever it is. It's part of the NAV and it's being given out. So that's basically what it is. So this is why index funds, which typically don't have much yield, they don't give out much income, or growth stocks, most of them don't even give income. They have much more exciting, much more upward trend stock prices than income-oriented funds. And that's why, right? Because the more income the fund gives, the more the stock price is not going to look as good. It's only normal, right? Because think of it like whether you get the return in income or you get the return in capital appreciation, in the end, it's still return, right? It comes down to the same thing. So you have to make sure, what I'm trying to say here in general is you have to count the income. So instead of looking at just the stock price or the stock chart, you have to count the income. So your best bet is always to look at the compound return. That is the best way to look at how a fund is actually performing, how a dividend or any stock that gives income is actually performing. So let me show you a few examples here. So hopefully we could piece this information together and it'll make sense. All right, everyone. So a few easy examples. Let's look at Canoe EIT Income Fund. Okay, this is probably the most popular closed-end fund. It's one of my key positions and probably one of your key positions as well if you're going to become an income investor on the Canadian market. So if you scroll down, you could actually see, and this is pretty much the same thing for every fund. If you go on their website, you got to look at the performance. So when you usually click on performance or find the performance, you will usually see the annual compound return. That includes the income. And sometimes, like in this case, they actually compare EIT to a index that it's kind of tracking or it's trying to beat. So EIT.UN is basically a fund where they stock pick. It's managed by Canoe Financial. So there's some mostly Canadian stocks in here. There's some American stocks in here, but they pretty much are comparing it to the S&P TSX comp. So the S&P TSX comp is basically an index that easily measures or tries to measure the overall performance of the entire Canadian stock market. It's the biggest and most popular, one of the most popular indexes. Think of it like, there's the S&P TSX Composite Index. It's very, very broad. It's like the whole Canadian market. That's one. Another popular one is the S&P TSX 60 Comp, which is the 60 biggest companies on the Canadian stock market. So those are typically the two indexes that measure how the overall Canadian market or Canadian stock market is doing. On the US side, it's the S&P 500, right? So if we look at since Canoe started, since the first day it started, on average, you would have a total return of 9.7%. If you would have invested instead in an ETF, there's plenty of ETFs out there that follow the TSX Composite Index like iShares. I'll show you that in a second. So basically this ETF here from iShares, very popular, XIC, is literally the iShares Core S&P TSX Capped Composite Index, right? So it's basically, that's what it is. And here is the 61, like I said, the S&P 60 ETF. So these two ETFs try to track basically that index. So think of it like an overall indication of how the Canadian stock market is doing. So if you compare EIT to this index, EIT blows it away. So EIT, in terms of total returns, this is on average since inception, since its creation. You even have the last 10 years, you have the last 5 years, the last 3 years, the last 1 year. So as you could see here, pretty much every time EIT is beating the overall stock market. So EIT fund is, my hat's off to the management team because they're good stock pickers. It means they're beating the overall stock market, which is very hard to beat, the Canadian stock market, of course. So if you look at the actual, the S&P TSX Composite Index, here it is. Okay, if you click on Max, I have it since 2006. So since 2006 until now, the overall Canadian market went up 68%. If you look at EIT stock price, since the same time, we're talking, 2006, EIT stock price went down 40%. So you might be asking, well, how is it possible that EIT is beating it? It certainly doesn't look like it with the stock price, but that is because the stock price does not include the income. You got to include all those little 10 cents a month, every month, month after month after month after month. If you pile them all up, basically it would blow away. It would be much more than plus 68%. But they're giving it out in income to its investors. So you have to include the income. This is a perfect example where it looks like this fund is eroding. I mean, $20, now it's 12 something, minus 40%. How could that be a good investment? You have to count the income. Right, so total return, annual compound total return is what you have to look at. Let's look at a split fund now, the Brompton Split Bancorp, which is a very popular split fund that just has the 6 banks. You click on performance and you will see the same thing here. For the Class A shares, the annual compound return on average, so this is the average gain you'll get, and this of course includes the income, is over 10%. It's over 10%. So basically SBC also beats, and in the last 10 years it's 14.9, etc., which beats EIT. So that's just goes to show you the power of the 6 banks, right? So basically what this is saying is that owning the 6 banks with SBC blows away just owning the overall Canadian stock market. So this just goes to show you the power of the Canadian banks. If you look at another split fund, which is a little bit more broad, and this has many Canadian dividend stocks, not just the 6 banks, so it's more diversified. So we could easily compare it more, or it makes more sense to compare it to the TSX 60 or the TSX Composite Index. You're looking at a total return since inception of 8.3. That's because of a big dip recently, right? This includes the income. So if you look at the stock chart, you'll never see that you're making 8.3% return a year on average, or in the last 10 years, you're making 14.5%, right? Because you have to include the income and the stock chart doesn't include it. So if you actually look at, let's look at the TSX 60. If you look at the performance, you will see that, on average, so this is like owning the overall Canadian stock market since inception. This fund, I think, was created in 2000 or 2002. It's a really long time. You see the numbers here, 7.25 on average, 8.74 in the last 10 years. So this is what you have to look at in terms of, it's basically telling you how the overall Canadian stock market does, right? So this is the big one, which is basically not just only the 60 biggest stocks, but the whole Canadian market. It literally says here, own the entire Canadian stock market. You look at the performance, it performs a little bit not as good. So this is basically telling you that if you own the top biggest 60 stocks on the Canadian market instead of the whole Canadian market, you're better off. That's basically what it's telling you. So you have to look at the compound returns, everyone. So if you look at DFN also it's the biggest split fund that always, I keep getting complaints about it. It looks like it's just eroding over time. If you look at the compound returns taken from 2021 annual report. So this is until July, I believe, or something like that, 2021. So it doesn't include the big dip recently. So this is why the numbers are a bit better. But I expect that the numbers up to now are pretty much very similar to DGS, because they kind of hold the same stock. So I'm expecting that, when the new circular comes out next year, you'll probably see something like 8.3 or something like that since inception. So you have to look at this stuff, everyone, before you invest. Let's look at another example. So here's ZWC, right? ZWC is a vanilla covered call ETF that holds 35 of the best Canadian dividend stocks. So very well diversified. If you look at the performance, since inception, only 4.58. So that means since this fund was created in 2017, on average, stock price and income, you would only get a return of 4.58. So you might be asking, well, why is it low compared to the split funds, compared to EIT? That's probably a topic for another leverage, but I'm going to give you the answer in one word answer here: leverage. That's why. This is not leveraged. But if you look at the 1 year here, 1 year is 3.24%. If you look at the 1 year of the TSX 60 or the TSX capped, if you look at the 1 year, minus 3.9, minus 2.55. So if you own the overall stock market, you would have fared much worse, or one of these two ETFs, you would have fared much worse than owning ZWC. You would have got a 3.24% gain instead of minus 2.55. Why is that? Because of its covered call nature. So covered call give a lot of income out. So this is why I always say, everyone, that basically, and this is the proof right here, covered call strategies will outperform typically when there's a bad year, when there's a bad market. You want more proof? I'll give it to you on the American side. So on the American side, the king of benchmarks that usually is compared, everything in America is always compared to the S&P 500 index. And I'm basically the top 500 companies in America, pretty much the equivalent of the TSX 60, right, on the Canadian side. So S&P 500, the biggest, the first, the most popular S&P 500 ETF, vanilla ETF, no cover calls, is the SPY, right? You'll hear it, the SPY. So this ETF, I think, is the first S&P 500 ETF. VOO is another one from Vanguard. There's a bunch, right? So the SPY, if you look since inception, 1993, NAV market value, this ETF, or basically the S&P 500, would give you an annual compound return per year of 9.62%. So, this makes complete sense. The American stock market always typically outperforms the Canadian stock market by 2%. So the overall Canadian stock market, usually you're looking at 7 to 9%. The S&P 500 or the American stock market, 8, 9, 10%, depending how far back you go. So, and here we go. We could do the comparison to XYLD. So XYLD is literally S&P 500 with covered calls. SPY is S&P 500, no covered calls. Let's compare the performance in the last year, which was a down year, bad year. Minus 10% here on the SPY. But on XYLD, it's only minus 3%. So the XYLD in the last year has basically outperformed the SPY. So this just goes to show you that covered call ETFs, which has the same thing as a non-covered call ETF, will always outperform during bad time. Very important, during the bad time. But long term, we're talking long term time horizon, usually the index will win, right? You see that 9.62. But if you look at the inception price and performance at the inception, which is right here since inception, you'll see that it's 7, right? It's less. So the SPY beats the XYLD over time. And that's because the market is usually more up than it goes down. So covered call strategies, anything that use covered call strategies, are defensive. You're paying for that defense. You will do better than the overall stock market typically during the bad times, but in a strong bull market, when the prices go up, you're not doing as well. So hopefully this explains what total return is and how you could compare and what to look at. So the key really to look at, everyone, is always the annual compound return. If the fund gives income, you have to include the income in your analysis, and the easiest way to do that is to look at the annual compound returns. So let's summarize what we learned in this video. Hopefully what you learned. So point number 1 to remember: a stock or fund that gives out any income whatsoever, distributions, dividends, don't look at the stock chart. You have to look at the annual compound return. It's a much better indicator of how the fund performs, right? We all know how the overall Canadian market performs, approximately 7 to 9% on average. The American one, 1 or 2% higher. So if you're making annual compound returns on a fund and it's 8, 9, 10%, whatever it is. If it's Canadian stocks, you're going to expect a bit lower, and American stocks, you're going to expect a bit higher. So if you're at those numbers, the fund is performing just as well as the index or the overall market, even though the price seems to be going down. Another thing is NAV is not eroding. It doesn't erode. It's being given out to shareholders as a realized returns, right? What you do with it is up to you. Whether you drip it or not, it's up to you. But that 10 cents a month you get, that's a realized return that shareholders get, right? So stock price increases or capital appreciation is 100% unrealized until you sell. Don't forget that, right? The monthly income that you get is realized every month. It's realized return. So next point, whether you get your return with capital appreciation or income or a combination of both, it's still the same thing. It's still considered total return. So stock price alone does not give you a good indication at all unless the stock does not give out any income. Like I mentioned earlier, right? Google or Tesla. Then you can look at the stock chart all you want because it's fine. It's all stock chart. There's no income. So that's okay. If it gives income, just looking at the stock chart, completely pointless. So income-oriented funds, everyone, have a huge advantage over index funds or funds that don't give out much income or at all, because the realized returns are being given out consistently all the time, whereas the income funds generate pretty much the bulk or almost some of them all the returns with capital appreciation or stock chart or stock price increase, no income. So you're always stuck basically. Because to realize your gains, you have to sell. You have to sell it, right? Buy low, sell high. If it doesn't give income, that's your only way to make money. So this is why if you're an index investor or a growth investor, you're always looking constantly at your stocks and trying to decide when do I sell, and you're always looking at it and you're always worried. Income investors who just buy and hold and get their returns with the income don't have that problem, right? And last point, you could always compare a diversified fund to a comparable index like S&P 500 if it's American stocks, or TSX 60 or TSX Composite Index if it's a Canadian portfolio, right? So you will see that that's basically the best way to compare how a fund is doing versus the overall market. If it's doing better, well, that's great. That's actually doing very, very well. If it's not, it means that you would be better off investing in the index, basically, or XIU or whatever it is, or the SPY in the US, right? So keep that in mind. So you will quickly notice that after looking at all the annual compound returns, that typically the ones that don't be the ones that are income oriented, like covered calls, covered call ETFs that don't beat the overall index, are typically the ones without leverage. Split funds, EIT, which is not technically a split fund, it kind of has a structure, but it's leveraged. So split funds are leveraged. So that's what helps to beat the index. That's pretty much the only way I think a covered call ETF could ever beat the overall stock market is if it has leverage, right? So that's why you see the ZWC is underperforming the actual index, right? It's completely normal. It will beat the index during a bad market, but long term down the line, it probably won't, right? So covered call ETFs, don't forget everyone, they were designed for less volatility. Less volatility, what does that mean? Is it just stock price? Not really. I think you have to consider less volatility in your returns. You get more consistent returns, whereas index fund or growth stocks, you could get Thanks for watching, everyone. Really appreciate it. Make sure to hit that like button, that thumbs up button. It helps the channel grow, so it's a win-win. Also, make sure to subscribe if you're not already subscribed, not to miss out on my future content. It's all about income-focused investing. And also, you got to be subscribed if you want to participate in my surveys where I ask the audience, I ask you what topic you want me to cover next. So very important, subscribe, hit that little bell button so you are notified of any new videos and any new surveys as well. Make sure to check out our website. We have a website, passiveincomeinvesting.ca. That's where you could purchase my digital product that I'm very proud of, the ultimate DIY investing package, which is on version 3 right now. So this is a reference tool. It's a companion tool to help you build your own custom portfolio. It's good for Canadian investors and American investors. So it covers both the Canadian and American stock markets. It has sample portfolios as well, multiple sample portfolios for different investing styles. So it's a very cool product, and it does come with lifetime updates. So you only have to purchase it once. My intention is to come out with a new version every single year. So you purchase it once, you never have to pay for it ever again. You'll get the lifetime, the updates for free forever. Also, right there on my homepage on the website, I do offer a one-on-one coaching session. If ever you want a little more personalized help, it's a 1-hour Zoom call with yours truly, a one-on-one with me where you could ask me anything you want. We'll go through your situation and I'll give you my opinion on how best, I'll help you best I can, basically based on my opinions. Just keep in mind that I am not a licensed or registered financial advisor or financial planner. We also have a Facebook group, so join us there. Passive Income Investing, over 11,000 members. We try to get the spams and the scammers out of there as quickly as possible. So it's a very, very clean group. Everyone's asking questions, trying to help each other. And it's a really, really cool and fun community. If you want a little bit more personalized stuff on our day-to-day life, follow us on Instagram as well. We recently moved to Panama, so if you want some more information on more personal stuff, you could follow us on Instagram. My mission, the mission of this channel, will always remain the same, everyone. It's to help everyday, regular, normal, working people to invest on their own, do-it-yourself investing, right, in order to build their own stream of passive income to enhance their quality of life and one day become financially free, financially independent. Very important goal. So, as usual, continue to stay safe, everyone. Stay healthy, and of course, stay passive. See you next time.